what I'm seeing. There we go. Okay. All righty. All right. Well, good morning. And I see some people I know on this list. That's wonderful. Good morning, and thank you all for attending today's webinar on Builders Risk Insurance. I'm Shari Deutsch from the Central Contra Costa Sanitary District, and I will be your moderator this morning. Builder's risk can be confusing for even the most seasoned risk management professionals. Our property policies generally exclude coverage for sites or structures under construction, which is why we require our contractors to provide that when they do that kind of work for us. So but that creates all kinds of confusion and complications. And we have a presenter here this morning who will address these important aspects of builder's risk. I'd like to introduce Anthony Carlton from Gallagher. Prior to his work for Gallagher, Anthony worked as a public entity risk manager who was involved with capital programs of over hundreds of millions of dollars. So he knows his stuff from both the public entity side as well as the broker side. Mr. Carlton's presentation will last about 30 to 40 minutes, which leaves time at the end for questions. So feel free to post questions in the chat. And with that, I will hand it over to Anthony.
Great. Thank you so much, Shari. Let me post my slides real quick. Okay, let me know if everybody can see it okay. Shari, if you can see it, I will move it to
Gotcha.
this style. Does that look great?
Looks good to me.
Well, thank you everybody for having me. Once again, as Shari mentioned, my name is Anthony Carlton. I'm with Arthur J. Gallagher. I'm an insurance broker based out of Southern California, representing primarily public entities. And as Shari mentioned also, I came from the public entities. So I like to always tell people that I share your pain. I share your history of working within the confines of the public sector and making sure that we do everything we're supposed to and the way we're supposed to do it in the most transparent and positive way possible. So today we really want to talk about a very high-level overview of builders risk insurance. As we go through the presentation today, as Shari mentioned, we'll have time for questions. This is supposed to be a high-level overview of builders risk insurance for those of you. If you need any other additional details from me, my contact information will be at the end of the slides, and would love to reach out. If you reach out, give you some additional information and help you any way I can. So that being said, today we're going to kind of hit four major topics. What is builder's risk? So that intro. What are the major differences between when an owner and a contractor purchases? I know Shari mentioned at the beginning, a lot of times we ask our contractors to purchase it, but the owners can purchase it as well. And what are the differences between that? We're going to go really high level into what are some of the major contractual issues that are faced when creating a contract and requiring builder's risk insurance, and what are some of the pitfalls of that. And then one of my favorite slides is going to be some anecdotes of what could go wrong. What can go wrong will go wrong. I also love to use an old Dragnet phrase, which is the names and images will be changed to protect the innocent. But we'll talk about some anecdotes of things I've actually seen directly as a risk manager and as an insurance broker in terms of how the placement of insurance can go wrong. So that being said, we're going to jump right into kind of an intro to insurance. As Shari mentioned, my background before coming back to Gallagher in 2022 was 14 years as a public sector risk manager. My last role was as executive director of facilities planning, risk, and legal for a large public entity in California, where we did approximately $300 to $400 million worth of construction a year. And so I've unfortunately seen quite a few different projects, scale and scope. And then as an insurance broker, working predominantly with public entities, I've helped craft contracts as well as insurance policies and claims management for insurance issues that come out of construction. So that's a little bit about myself in terms of my background. I've gotten the chance, luckily, in my life to be on the public entity risk manager side, the insurance broker side, as well as I worked for an insurance company developing data models and analytics right out of college. So I've gotten to see all three sides. So I want to start with an intro to builder's risk. When approached by the team who was presenting or getting ready to present the webinar, they asked me to really kind of go high level into what are some of the biggest concerns I'm seeing in builder's risk right now, what is builder's risk, as well as some of the differences between things like an installation floater and builder's risk. So for all of you who don't know, builder's risk kind of sits in between a property policy and an inland marine policy in insurance. It is not a traditional property policy in that it's not intended to cover all risks, as Shari mentioned earlier. It's meant to cover risks that are in the course of construction. So really what you're doing here is this is covering the gap that occurs from your normal property policy while something is in construction. Kind of the two major categories of builder's risk that we see when we're placing policies are new construction, so ground up, new build, and then modernization or renovations. And so there are some differences in those as well, and I'll mention those in a little bit. So understanding builder's risk coverage at a very, very high level. What is builder's risk? Who buys it? Who's an insured, et cetera. So one of the things I just kind of want to start with is builder's risk is a property form typically for most insurance carriers. It could also be on their inland marine. And its intent is to cover damage to the physical structure or costs surrounding the construction of the building while it's in its construction. So who buys it? This is a loaded question that we're going to touch base on a little bit later in the slides, which is there is the ability for the contractor to buy it. There is the ability for the owner to buy it. And there are a lot of different methods in how you can buy it. There are standalone builder's risk products. There are installation floaters. And there are also something that this group, if you've never heard of it, master builder's risk programs that your contractors might have. That's where they have an annual program and they enroll and disenroll projects as they occur. So they don't necessarily buy an individual policy for each project, but they have an annual policy and then they enroll certain projects as they get started and they disenroll them as they end. Who isn't insured? I think this is a classic question that we get for all insurance policies. And the first thing I'm going to always say to hedge my bet is always review your insurance policy to confirm who is insured in the language that's at the very beginning of the policy. There is pretty broad definitions of who is an insured in builder's risk and installation floaters. Many times the large carriers will have very generic broad coverage that says anybody who required by written contract and has an insurable interest will be considered an insured. This is a very important thing. When the contractor's buying it, you want to make sure you as the owner are properly being brought into the policy as an insured. So we want to make sure as we go through reviewing policies, we understand who is going to be covered and who is going to be paid in the event of a loss. Really high level as well, what limits are provided? So I'm going to bring up some kind of terms, and if anybody has any questions as we get to the end, let me know. But a lot of times the limits provided are the project value or the construction values at the end of the project. So insurance and builder's risk does not kind of grow as the project grows. But if let's say you had a $40 million project, the limit of insurance will be $40 million from the day the project starts till the day the project ends. So that's really important. So the most risky for the insurance company the project is at its very end when the full insurable value is at its maximum. The limits provided, we always break into kind of some different segments as well, just to kind of put out there. One are the hard costs. So hard costs are your traditional labor and materials. Soft costs are for fees that aren't directly related to the building, including architectural fees, insurance, surveys, inspection fees. And then also some additional limits that may be provided, and I just want to throw this out there, are some sublimits that you should be aware of as well that are becoming really important and concerning. The two big ones I would focus on would be property in transit. So property when it's being moved to your project site, and also property stored off-site. So remember, a lot of the times the builder's risk is going to qualify that there's coverage being provided at the project site. So we'll get sublimits for any time there's materials being brought onto the site from off-site, and that could be including being moved, being shipped, being taken via train or semi, as well as being stored off-site. One of the major issues we're seeing right now, I kind of just want to point out there, is that with post COVID-19, we've seen a lag in being able to procure certain materials, especially electronics, HVAC, very complicated equipment. And so what we're seeing a lot now is contractors and owners are buying equipment up front and storing it off site. So that way they make sure when the project needs the equipment, it's ready to go and they don't have to wait for it. Now, what that brings up is the concern that, we're not appropriately insuring that equipment while it's being stored off site. While the builder's risk and installation floaters are intended for things that happen on the project site, they may have a small limit that allows for materials stored off-site. So I just really want to make sure. I had a recent public sector client who was building a $400 million structure. And one of the things they decided to do was buy all the electronic components and the HVAC components ahead of time, as well as the cooking for their kitchens. And we sat down, we talked through what the risk exposure was, and they said, yeah, we're going to have about $30 million worth of materials probably at one point stored in our warehouses. And I said, well, that's interesting because typically an insurance policy of this nature only covers maybe $5 or $10 million of property stored off site. So we're going to need to purposely address that and make sure that we increase that limit so we have appropriate values for all of that's being stored. So something I just really wanted to point out that's becoming a more recent issue is making sure that your sublimits meet the needs as well when you work with your contractors in defining what the scope is. So what is insured and what is not insured? I want to make sure that everybody understands, as I said, so materials, labor that's completed on the project site are all insured. Things that are typically not insured would include the contractor's equipment. Remember, you're not responsible for insuring their mobile equipment, their tools. That should be all covered by one of their own inland marine policies, like a contractor's equipment policy. We could go into a much bigger kind of breadth of construction insurance with liability and things like that. From a property perspective, the materials that are bought for the project are covered. The work that is done on the project is covered. And then if you do purchase soft cost insurance, that would be covered as well. But not covered is any of the materials that are not owned or you do not have an insurable interest in. So one of the first big questions I get a lot is, when do we use a builder's risk policy and when do we use an installation floater? And I'm going to couch that very high level, which is an installation floater is a very narrow policy. It's meant for very simple projects, not complex, very low cost projects that truly are built into the fact that when an equipment or some major piece of installation is occurring and that's it. Once it's installed, there's no longer a risk to the structure of the building. It's a very narrow scoped policy that's meant to protect primarily the contractor and the subcontractors as they're installing the actual equipment. Whereas builder's risk is a very broad form. It covers a lot more issues as well as the entire construction project from start to finish. Installation floater, as I said, is meant to cover the equipment. And then once the equipment's installed, it's meant to be done. Whereas a builder's risk policy is meant to be far more broad and go from the very beginning of the project to the very end of the project. It's also written on an all risk basis typically. So it's including vandalism, fire, theft, water damage, things like that. Installation floater, much more narrow in terms of which exposures are covered. And then, of course, the builder's risk policy, as we mentioned earlier, is based on the completed value of the project, not the cost of the equipment. So I really want to point this out there. I get this question a lot, especially from public entities in California is, when do we ask for an installation floater and when do we ask for a builder's risk? I'd say the vast majority of time you should be asking for a builder's risk. The times in which an installation floater is appropriate is probably a lot less and is more of just a pure equipment installation, like an HVAC system is being installed into an already existing system or replacement, or some other very simple installation. Another big question we get asked a lot is, we understand what hard costs are. So hard costs are, the labor and materials that go into the completed value of the project. But what's a soft cost? And why is it important that we're insuring the soft cost? One of the things we'll go into as we discuss more broadly the difference between when a contractor versus when an owner purchases the insurance is some of the things that may or may not be covered by the contractor's policy. And one of the big things we typically see is that the contractors don't usually cover soft costs or cover a much smaller portion of the soft costs. So one of the things we do is we work with our clients to review what are the non-materials and labor costs that are being incurred for the project and determine an appropriate value to insure. One of the things I like to throw out here, there's just kind of a quick list for you all, but obviously there can be a lot more items added to it. But architectural design and engineering fees are by far the largest soft cost you're going to see in the builder's risk side. We all know right now that those costs are not going down. They're very expensive. Land permit surveys, rentals, loans, fees for issuing loans, insurance could be a soft cost. So if you're paying for the builder's risk, project management, taxes, advertising. So these are costs you're going to incur if the project is delayed. So another way in which soft costs are typically called in insurance policy for builder's risk is delay in startup or delay in completion. So anything that delays the project from beginning or from opening will incur additional fees. So one of the things I like to say is, what if you were on the very last day of your builder's risk policy and you had a fire and 50% of your building was done and it's going to extend the project by another year and a half? Well, you're going to have not only additional labor and materials costs to repair the damage, you're also going to have probably new architectural and engineering fees that you're going to incur. You're going to have to extend your insurance policy for an additional year and a half. Those are insurance fees that you're going to incur. So soft costs can actually add up very quickly and become a very large component of a loss for a builder's risk policy. Okay. So one of the biggest probably debates we see in builders risk coverage and installation floaters is who should buy it. And so I'm going to try and create as unbiased, even though I know we've got all owners on the phone today, I'm going to create as unbiased of a picture of this as possible, because I think it's really important that we look at both the positives and the negatives of when you're purchasing it versus when the contractor's purchasing it. So I'm going to throw out a little anecdote in that I was a public sector risk manager, and I'm going to tell you I understand, directly as this group does, that getting our purchasing departments to procure something can be, timely and have a cost associated with it. So I understand that addition to the pros and cons I'm going to say, from a public sector perspective, sometimes it might be easier to roll in the contractor purchasing these policies instead of you going through the process and procuring them separately with your own insurance broker. So I know that's kind of an extra item out there that we don't typically look at. But one of the things I'm first going to say is the joke I make about an owner purchasing it, why it makes so much sense is you're the first named insured. And the joke I always say is, who do you want to get the check if something goes wrong immediately? Yes, there can be lost payee endorsements. Yes, there can be ways in which the contractor provides you the money. But when it's in the owner's name and the owner's the person who's paying for the policy, they're also the one who has all of the control if something were to go wrong. So one of the things I'm going to say is, if you ever decide to go with an owner purchase one, you do have more control over both the claims procedures, the purchasing, which coverages are in force, who you're using, and the information that's being provided to the insurance carrier. One of the things we also notice is that when the owner's purchasing it, it creates a little bit more consistency in terms of when does that policy switch from a builder's risk policy to a permanent property and policy. So with your current broker, we see a lot of good coordination when the broker who's placing the builder's risk is also the one who places the property policy. So for all of you who have a broker who's currently placing your property policy, if they're also placing your builder's risk, they're the ones who are making sure that when one trails off, the next one starts up. I'll just jump into one extra kind of component before I jump into the contractor side of this too, which is for everybody, there are kind of two different measures in which you can move a builder's risk policy to a property policy. And that could be occupancy, so when you actually occupy the building, or substantial completion. As I go into the kind of when the contractor buys it, I can tell you that they're almost exclusively going to ask that anytime substantial completion is met, that is the time that their builder's risk policy falls off and that you move it to your property policy. So I just want to kind of throw out those two phrases just in case you've never heard them for builder's risk policy. But also, in addition to looking at who's an insured, probably the very next thing you should be looking at is, when does that policy no longer in effect? What is the measure by which builder's risk is over and it's expected to move to a property policy? That is not uniform. That is insurance company specific. That can be negotiated. So I heavily recommend that you review that with your broker or you review that with your contractor. In addition, just on the last one on the owner side, if contractor places the builder's risk, they usually only cover specific coverages. One of the things I'll just kind of quickly mention, kind of a little bit of a under the hood. Contractors use insurance sometimes to add in administrative fees, but they can also use it to help reduce their costs as they move forward. So one of the things we have seen from a contractor provided side is that they may reduce the coverages in order to reduce the cost to increase their profit margin. So just something to kind of take a peek at while you're reviewing your bids as well as your insurance documents from your contractors. Um, and then from the contractor side, the contractors usually have what we call a master builder's risk. And I kind of mentioned it earlier. So you can buy an insurance policy for each individual builder's risk, each individual installation floater, or if you're a big contractor who's doing a lot of projects, you can buy one for the year and get predetermined rates and not have to underwrite necessarily every single project. So this can equate to a faster, more efficient process by which the contractor's already negotiated the rates and they're just enrolling. It can reduce the amount of time necessary to gather documents and underwrite the account. And then it also usually includes quite a bit of added coverages. So we do see in a lot of master builders risks embedded flood, earth movement, and windstorm coverage. So I think I mentioned earlier on when we were defining what a builder's risk is in terms of all risk coverage. All risk typically does not include flood and earthquake or earth movement. So one of the things I'd also just kind of mention, whether you purchase it yourself or you go through a contractor, is to understand the exposure necessary in your project. From a flood perspective, usually one of the great things to do, whether it's your contractor or yourself, is to have your broker run a modeling, a risk meter or some other modeling report to see what the flood zone is, to see what the earthquake likelihood is in that area. Another common model that's being done right now for builder's risk is to understand what the wildfire exposure is, so that as you decide to build the policy, the coverages, you know exactly what could potentially happen. So understanding what the likelihood of an event is to occur there, and then also putting that against what the project is and what the exposure is in the project. I know being water districts and utility districts and waste treatment facilities, you may have a lot of your projects be underground utilities, which may not have as much concern for flood and earth movement. But that being said as well, I use the term earth movement versus earthquake. That could be a lot more broad and include things like subsidence or the ground shifting, mudslides, things like that. So truly understanding what's included in your policies and what's not is very important, as well as what's excluded. Just kind of a thing to think about is remember from an owner or contractor side, you can go either way in terms of purchasing it. When it's the owner purchasing, you have a lot more transparency into the process and what's being provided to the carrier and what the terms are. And with the contractor side, you may be a little bit less aware of what they're purchasing. Second. Okay, and I just like to throw this out there. As we jump into the kind of the contractual side of the relationships, this is probably a very standard GC model of a project. Some of you might also be doing what we call multi-prime, CM multi-prime. So if anybody hasn't heard of that, I can definitely discuss that more in the question session. But a lot of times a water district or a public entity hires a general contractor, and then they use subcontractors to perform some of the specialized work. And you create this larger relationship. The other model, as I mentioned, is a CM multi-prime that we see quite a bit. Construction manager with multi-prime contractors. Instead of one general contractor, you have a general contractor for every portion of the work. So you have a general contractor for cement work, you have a general contractor for plumbing work. That can create some contractual changes as well. One of the things I just wanted to mention from a builder's risk perspective is understanding the relationships that are out there, and then understanding who is covered and who is not is probably one of the most important things as you're developing an insurance policy. So some of the contractual issues I wanted to talk about are who is insured. I just kind of mentioned that. When you were going through the contract, I know one of the things the group talked about when we were forming this webinar was we're not going to go too deep into the the formation of contracts and the negotiations of contracts. We know that for a lot of you, that might be done by your purchasing team, that might be done by your legal team. But just wanted to make sure you understood that when you are reviewing those bid documents, those contracts that are occurring between you and your contractors, making sure you define in it who is an insured. I think I mentioned earlier when we were talking about the description of a builder's risk policy, a lot of times they'll have a provision in there that says when required by written contract. Many of you are probably aware of that from the additional insured and waiver of subrogation side, but it's also very common in the who is an insured in a builder's risk policy. So it's very important to note that in your contracts, you define that the contractor and the subcontractors are named insureds as well, or additional named insureds, to make sure they have that coverage, because many times you'll be creating that contractual relationship. Also, what's really important as you define your bid documents and your contracts is what coverages are you requiring, what limits are you requiring. As I said, if you don't say what you're requiring of your contractor, they will more than likely create as bare bones policy as possible to get the best price possible. So be very explicit in terms of your definitions of what you want covered. And then also one of the things I just wanted to point out here is be very mindful as well that some things just don't exist in the insurance industry. So I'll tell you, I was just recently working on a project that's about $300 million in scope, and it's in a very large earthquake fault zone, and they wanted $300 million of earthquake coverage for a $300 million building. It's not to say that that's not available in the marketplace, but the cost would be astronomical compared to the builder's risk policy. So one of the things we do is we work with the contractor and the owner to understand what is the true risk posed by the earthquake or the earth movement, and what is the appropriate sublimit or smaller limit to purchase. So when you're drafting your contracts, when you're creating your responsibilities, just understand what the exposures you'd like, but also make sure that it balances out with the cost. Could you require your contractor to provide $300 million of earthquake? Sure. But if your builder's risk policy is going to cost $100,000 and your earthquake is going to cost $2 million, it's probably not going to be the most efficient and cost-effective policy. So working with them to understand what's available within their programs, what's available in the market, as well as what's prudent for the exposure that there is. The next line I always like to talk about should be well-defined within a contract, whether it's liability, whether it's in the property components such as builder's risk, which is who pays the deductible. On a lot of these programs, the deductible could be quite large. So some of our master builders risk for our contractors could be $100,000, $500,000, or even $1 million retention or deductible. So understanding who has the responsibility to pay for that. The other thing, and just kind of a quick trick or note of the trade that to look out for, is a lot of times when contractors do have high deductibles, they actually charge for funding the deductible in your bid. So what they'll do is they'll say, hey, we're going to put your builder's risk in our master builder's risk program, and they may not disclose to you that they have a $500,000 deductible. But what they're going to do is they're going to add additional costs into their bid to cover that deductible, even if they don't have a loss. So one of the things you may be able to negotiate is, one, reducing that administrative cost, or two, we have seen as well where contractors put in their language that if there is not a loss, that they'll rebate that deductible funding back to the client if there is no losses and the project is free from losses. And then the last bullet I just kind of wanted to point out in this slide was, what are the major exclusions and what do you want to be addressed in your contract? So one of the things we see, and I just wanted to point out, is a lot of times your contractors, when they do the builder's risk, are also doing the liability. And they could have what you call a RAP program, or a contractor controlled insurance program. One of the big exclusions you're going to see, and I won't get too much into this today, but if anybody has any direct questions, is a COC exclusion, a course of construction exclusion, in their liability program, which has the ability to impact the way in which the builder's risk policy pays. And then the other major coverage that we see excluded that you would like included would be called Leg 3, LEG 3. So in insurance, there's leg 2, leg 3, and that has to do with components of design defect while in the course of construction. So I can definitely go into more of that if anybody has any questions or has had any issues with this. There's been some really great recent litigation and case law that has come out of leg 3. So we are starting to see a lot more pushback from insurance companies in terms of what is covered and what is not. So these are kind of high level things I just want to make sure we talk about, which is when you see the exclusions portion of both the proposed builder's risk program as well as the contractual requirements, it's something to very much take note of. Okay. I remember Shari and I having a great discussion about this one, which was how do you know the insurance the contractor said was going to be put in place actually was put in place? That's a great question. So as we know, I love to make that joke that if you read the top of an accord form, it usually says, this is not insurance. This is not, you can't take this as being insurance, and you have to look at the actual insurance policy to know what's going on. So one of the first things I'm going to call out is most of you probably typically get from your contractors a certificate of insurance. So it's meant for liability and workers' comp and things like that. And what they'll usually do is at the bottom where it says miscellaneous coverages or other coverages, they'll throw in the builder's risk with one total limit and call it a day and say, hey, you should be happy you're getting this. One of the things I mentioned to Shari right away when we were having this discussion is I love the evidence of commercial property insurance form. So the one you see on the screen, it shows the sublimits far more. It shows if there's any other major provisions that you should be concerned about from a property perspective instead of just one lump sum limit. Will this show you all the things you need to be concerned about? Absolutely not. But it's a lot more detailed and it has a lot more components that will help show you what you need to be concerned about. One of the things I also like about it is it usually shows you what the deductible is. So if they leave the deductible portion blank, that usually raises a red flag for me that they're not wanting to disclose the deductible for a reason. And then I usually follow up with where is the deductible on the form. So I highly recommend, if you're not currently requiring in your bid documents and your contract documents an evidence of property insurance for the builder's risk, that you switch to that model instead of just saying a traditional certificate of insurance. Um, the other thing I'm going to say is, and this is the gold standard, is in your bid documents and your contracts, I highly recommend you put a request for the full builder's risk policy or any policy that the contractor procures for your project, that you have the right to review it and you have a certain amount of time after the project starts to get a copy of it. We have seen time and time again where I don't want to call out any insurance brokers out there, but we have seen where insurance brokers maybe aren't as detailed on these evidence of property insurance or certificates and maybe don't disclose everything fully. And then once we see the full builder's risk policy, we realize there's a lot of exclusions we don't like, the coverage isn't appropriate, there's sublimits that are highly reducing the amount of insurance provided. So that is a really big important thing, is that if you can get a copy of the policy, review it. And if you got a good broker, which I'm sure you all do, have your broker take a look at the builder's risk policy against your bid documents and say, hey, this is what we required. This is what we got. Do you have any concerns? Give me a quick little write-up or narrative, and then have them help you push back with the broker for the contractor. That's their job, and they're really good at it as well. And that's kind of what I mentioned in that last bullet, is utilize your insurance broker. Remember that they're there to help you, and they are specialists in this, and their job is to make sure that they're reviewing all of the provisions of not only the bid documents, but also of the documents that you receive from the contractor. And then the last section before we jump into questions, I got about 5 more minutes, is the what could go wrong. So I always kind of like to end with this, which is both as a risk manager and as a broker, I've seen things go wrong all the time. One of the first things I wanted to mention, and I'll kind of go through some of these, is a lack of expected coverage. So we have seen over and over again where the contractor is required under the contract to provide certain limits, to provide certain coverages. And I will tell you, the vast majority of the time, the contractor is going to tell you, of course we have that. And they're going to send you a certificate, or they're going to send you a policy, and you look at it and it's not on there. So I will tell you, make the assumption, and I hate to say this, that your contractor has no idea how insurance works, and they're going to tell you yes to everything you ask for because they just want to move forward with the project and get paid. And they're going to put it on you to make sure that everything's in place. So I highly, highly recommend you always review their coverages, because there's been probably more than a dozen times in my life where somebody said contractually they did something and they didn't do it. The next big project I saw was within the last 2 years was actually a public entity I was helping as a broker. And the general contractor was having some difficulty procuring insurance. As many of you may know, in the last few years, Wood frame construction was very expensive, especially with all the wildfire concerns. And the contractor was having trouble procuring insurance for the amount they said they were going to within their bid. So they decided to lie with their broker and say that it was a non-combustible project instead of a wood frame project to get a better rate, so they would be under their number and they would be able to move forward with the project. Well, unfortunately, something happened, and we had to notify the insurance company of it. And the insurance company found out that it was a wood frame project and were immediately concerned that they had been misled um, in terms of what the scope of the project was, as well as the classification of the building type. And they were very quick to say that if there was a claim, that they were not going to pay it because the policy would be void for material misrepresentation. So that's another reason why it's very important to double check what the contractor is doing, that they're appropriately referencing the project to their broker, that their broker is appropriately referencing it to the insurance companies, because at the end of the day, you're the one on the hook if something goes wrong and the policy doesn't pay. And I can assure you that it's going to be a lot harder to get that money back from the contractor from a breach issue than it would be from an insurance policy. Something I didn't mention that I just kind of want to go back to before I kind of move on with some of these tales is, um, maybe for a lot of you, if you're not from the insurance side or insurance is one of your multiple hats that you all wear, I know a lot of you have to wear 4 or 5 different hats in your roles. But one of the things I just wanted to mention is remember that in addition to the limit that you're placing, the other major things that go into how they rate and how they quote a builder's risk policy are the construction type. That's probably one of the biggest things. So whether it's wood frame, masonry, non-combustible, fire resistive, there are kind of several different construction types that highly affect the cost and the coverages you can get. And then the second major thing is the time in which the policy is going to be. So it is a time-based policy. So if it's an 18-month project, it's based per day, et cetera, versus a 24-month, it's gonna cost per day. And then the last thing I would also say on that is, before I kind of jump into the rest of these tales, is in addition to those limits, one of the things you're also going to see, and as it tails from a broker right now, are the deductibles are kind of getting out of control in property insurance. Whereas we used to see very commonly $25,000, $10,000 deductibles on builder's risk. It's very more common now to see $50,000, $100,000 deductibles for builder's risk, maybe even $250,000. And then they're also splitting the deductibles. So for fire, vandalism, and theft, you might have one deductible, a smaller one. And then for water damage, you typically would see a much larger one. So on a project where I have a $50,000 traditional deductible, I might have a $150,000 or a $250,000 water damage deductible because that's where insurance companies are seeing quite a bit of claims. So defining those deductibles in your bids are very important, and also setting expectations for your team. If you are the ones on the hook for paying the deductibles, what you should set aside just in case something happens are very important. The third bullet point on the claim disputes I've seen, I recently also had one where the contractor had a master builder's risk and was doing quite a few projects with this public entity. And they said, oh, don't worry, we're enrolling everything. Well, a claim happened and we looked back and they never enrolled it. And the insurance company said, you didn't enroll it, so why would we cover it? So if the contractor is pushing forward to you that they are enrolling your project into their master builder's risk, their annualized builder's risk program, ask for them for some proof that it was actually added, not just a certificate of insurance of what their master builder's risk program is, but some kind of confirmation that the insurance carrier received the program and its effective date. That's very important. One of the big things we've also seen is this gap that can be created when a contractor stops their builder's risk policy, but you haven't added to your property program yet. A very common concern and issue that comes up. So it's one of those handoffs that needs to be very careful and needs to be done with a lot of expertise, which is the day that the builder's risk policy comes on, you better make sure that your new structures are being added to your property program. You want to make sure there's no gaps and there's not a day that it's occurring. One of the things I'll also say is we have a lot of contractors who want to push the construction off of their master builder's risk, off their program. So they might still be doing some work. And depending on which commercial property insurance program you have, they may not be excited by construction still occurring on the building while you're trying to move it onto their program. So not only do you have to have a really good definition of what's included in the builder's risk, but you're also going to need to have a really good definition of what's included in your commercial property program and what's allowed and not allowed to be covered. I think Shari mentioned at the beginning, most commercial property programs exclude your property while under the course of construction. So truly understand how that provision works. Some of your programs might have a small threshold, like they'll cover a certain amount of small maintenance work, but not large capital projects. So I highly encourage everybody to go look at your commercial property program to understand what that covers and does not cover. And then also if you have any major builder's risk programs, to understand how that's going to work and drop off. And then the last one is something I see also very often, which is what happens if the project starts before the coverage is in place. So as a broker, and I don't blame any public sector risk managers, but it happens quite frequently where the facilities department or somebody will tell us, oh yeah, that project started a month ago. And they've already finished all the grading. They've already finished some of maybe the footings and some of the excavation work. And so the question happens is, what happens when you don't have your builder's risk policy in place when the project starts? And one of the things we want to make sure is that those align as best as possible, because we don't want a continuity issue where, maybe the insurance started a month after and the footings were not part of that original coverage. That could create some issues in which the insurance company says, we don't want to cover that portion of the project. And now you've got an uncovered portion for the rest of the project. The other thing, as you all know, you might have to provide as a known loss letter. I've recently had a client who provided a known loss letter and then found out they had a claim during that period. So it's really important that we try and get ahead of things. I would say 5 to 10 years ago, getting a builder's risk policy in place was a very quick, rapid process. Unfortunately, in 2026, underwriters are a lot more sophisticated and want to underwrite every risk. So it could be a couple weeks, maybe even a month to get some of these quoted. So just understanding that any kind of pre-planning that you can do ahead of time will pay dividends in terms of reducing any of these potential issues. So highly recommend for continuity of coverage. You have coverage in place from day one of the project, from the very first day you're starting to do any work on the project, especially any day you have any material on the project, whether it's even being constructed or not. Once the material's on site, it's very important, all the way till the end, and it's moved on to the property policy, so there are no gaps. So that being said, we always end our slides at Gallagher with just some of our, kind of our company ethos, in terms of how we act and how we really believe in transparency and ethics. One of the things I would always ask you to do is really push your brokers and your insurance professionals to be upfront with you, to be, to provide you clear, transparent information, and to be your, consultants and your professionals. So really use your brokers. I'm going to have my name at the end of the slide as well. As we go into the questions, I'll go back to the slide. But if you need anything from me, there's my email address. It'll be on the slide. Always feel free to reach out. So many of the people on this call are Gallagher clients, so you can always reach out to your broker as well. But if anybody has any questions, anytime I speak, I'm more than willing to go into it deeper. I know we've even had talks about maybe doing like a 201 course for a really more in-depth on some of the direct provisions I mentioned today. But if any questions come up, I think we're perfect on time for Shari and the group in terms of right at that 40-minute mark. So then that way we have plenty of time for questions to finish on time today.
All righty. We do have some questions in the chat. Chris, do you want to handle that, or you want me to do it?
Absolutely. It looks like our first question is from Sunny. And the question is, I see often a course of construction for the limits. What does this actually mean?
So course of construction is just synonymous with builder's risk. I would say it's more of an older phrase that you see it a lot in policies. So you might see in your bid documents, course of construction as the verbiage. I would update it to builder's risk, all risk, things like that. But it is substantially the same thing. It is kind of also known as, AKA. So course of construction is while the building is under course of construction. I think we mentioned also kind of the big differences between the big differences between a renovation and a new construction. A lot of times we see COC for course of construction for a renovation in your property program. So it'll say if the building's already in existence and you're covering it, we shall not cover the course of construction. So any changes while in the course of construction, you'll see that a lot as well.
Our next question is from Benson. Is it unreasonable to require builder's risk insurance after substantial completion while contractor wraps up some small punch list items? Is there an industry standard?
Yeah, so I'd say the contractors are going to always tell you that substantial completion is the industry standard. That being said, as I said, it is a negotiated fact or a negotiated item. So one of the things I would say is understanding when you can move it onto your property program. So that's one thing that you're going to really have to know ahead of time to understand when your property program will allow you to, and then understanding what those punch list items are that are remaining, whether they are truly small fixes versus true construction. I will tell you, I have many a contractor tell me, oh, we got a punch list item left. And I'm like, what's the punch list item? Oh, we got to finish the electrical system and it's not active yet. Yeah, that's not a punch list item. That's substantial amount of work. So I would say, true punch list items, right? Like, oh, we found, a small hole in the wall that we need to fix, or there's an imperfection in the tile, or the floor is not settling appropriately. Yeah, that's something that can be fixed after it's moved onto your property program. But if there's still true construction occurring that was in scope, I'm very reticent to move it over to the property program and put it on your risk.
And a follow-up to that, is it unreasonable to state that the builder's risk policy will remain in effect until notice of final completion instead of substantial completion?
So usually they don't want to say final completion, and the reason why is because then if there is conflict in terms of one of those punch list items or something to do with a change order or scope, that could drag out for quite a long time. I actually have a project, I won't say which public entity in California right now. The project was originally slated for 3 years. It's on year 6, and now they're in litigation, and it's not technically finally completed. So I think they would have some difficulty in agreeing to that, because if there is that conflict and we haven't gotten to the point where it's technically complete, that they wouldn't want that on their books for that long. So typically it's finding that balance between one, you also don't want to pay the extra cost to have that policy in effect when it can move to your property policy and it's appropriate to move it to your property policy. So I'd say substantial completion is probably the most common. To occupancy is the next most common, but I have not seen final completion as a common kind of semantics for what to put into your bid documents.
Next question is regarding COIs. How much do the COIs matter? And isn't the contract wording and indemnification language the most important, because with or without insurance, they need to defend, indemnify, and hold us harmless?
Yeah, so I agree. I think indemnity language and the duty to defend are very important and probably the most important, right? It creates the contractual relationship. It creates the obligation under the law. I will say, I always have to say this because I'm required to by my corporate. I'm not a lawyer. I do not give legal advice. Everything is from a risk management and insurance perspective. Okay, I said it. It's on the record. But to that point, I'm going to give you some tidbits as well. One of the ways that insurance companies are limiting coverage now is by reviewing the contract documents and making sure that they align with the expectations of the contract. So what I mean by that is, in liability, there's the additional insured provision, which says that you'll be added as an additional insured for the work as required by written contract. Well, one of the things that we're seeing now is insurance companies are limiting that language to say, if there is an insurance requirement in that contract that says you'll provide $3 million of limits, the AI now is only worth $3 million. We're going to cap the limit at the amount that's set in the contract. So I'd say, yes, the indemnification is very important, and the duty to defend is very important in your contract with your attorneys and your general counsel. But the insurance provisions are extremely important, and making sure that the insurance they provide matches what you've requested is very important as well. And the reason I say that is because, yes, you can fight a breach, but depending on the size of the company, they may not have the funds necessary to pay you back for any kind of substantial breach. They may not have the cash on hand. They may not be that large of a capitalized company. Whereas if you're requiring $5 or $10 million of insurance and it's a good rated insurance company, they will have that money. They're expected to be around. So do not say that the insurance is not as important as the indemnification. I'd say they're equally as important, and they both rely on each other. I think that's a big point.
Thank you. Um, are there any lines of coverage similar to a master builder's risk program for public agencies?
So an owner can buy their own master builder's risk. I have one client who was doing a very large project that had phases over a 6-year period. So it was $800 million of phases over a 6-year period. So they created their own builder's risk, master builder's risk program with an insurance carrier, and then they enrolled projects as they came on and came off. So a master builder's risk is not just a construction, a contractor's tool. It could be used by a public agency as well. It just typically needs enough projects and enough premium to make it worth it. So the insurance carrier needs to see that over a certain amount of time, there are going to be a certain amount of projects, and they're going to gain enough premium to offset any concerns of deploying that much limit. So, and then there are pools. Many of you are in pools, I know. So your pool may have some kind of master builder's risk solution as well built into some of theirs. So if you reach out to your broker, I would heavily recommend you ask them, hey, do you have some kind of builder's risk tool or program already set up? And they may say yes. So that's something to think about as well.
What are the best ways to handle builder's risk issues with pipeline installation projects and other non-vertical construction projects?
Yeah, so I think I kind of really went high level over it at the beginning, which is I really am reticent to do an installation floater because it's a very small amount of coverage in terms of it's just covering the equipment until it's installed. It doesn't cover the building itself if something were to go wrong. So if it's truly just you're installing a piece of equipment into an already set up system and it's going to be a very quick process and very low risk to the building, an installation floater may be the appropriate product, right? It's very inexpensive, it's very mobile, it's very, efficient. But if there's any kind of commingling going with the building itself, where the building could get brought in from a damage perspective, or it's going to have long-term impacts on the building, I would highly recommend going to a more traditional builder's risk that covers the whole project versus just the piece of equipment that's being installed. So the one I commonly think of, I like for installation floaters is you already have a current HVAC system in place. You're changing out the compressor. So you're going to take off the compressor and put on the compressor. Very simple. Those are the ones where I like an installation floater for. Maybe on an infrastructure project where it's just putting in a pipe, right? It's not impacting the rest of the system. It's just installing a new piece of pipe or a new pipe system. That might make sense for an installation floater. But anything that's going to impact the major structural components of the building, I would heavily recommend doing builder's risk policy.
Does the additional insured requirement negate indemnification?
No, 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 no. They are both needed in. I don't know why I said it like that. No, 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 no. So they are both needed equally for different reasons, right? So the indemnification is needed to create the legal contractual requirement for the group to cover you, regardless of insurances, as kind of was mentioned in the first question, regardless of insurance's place or not, right? It creates that breach, that contractual responsibility. The additional insured requirement really sits in conjunction with the indemnification, which is that connects the insurance to the indemnification, where the insurance company now is not only covering the loss, but is covering the duty to defend. So you're creating this indemnification requirement, and now the insurance is being required to cover that cost, whether it's a claim or it's the cost associated with the defense.
Do most contractors carry a master's builder risk policy? What are you seeing in the market right now?
I'd say a lot of the large contractors, a lot of your large general contractors will tell you, hey, we've got a master builder's risk policy. The only thing I would say is if you're doing some really large, massive projects or some very complex projects, they may not fit into their definition of what their master builder's risk will cover. So a lot of the times we'll see a max limit for wood frame construction of master builder's risk. So if you're doing $100-200 million project with wood frame, the master builder's risk may not cover it, but the vast majority of non-combustible and infrastructure, they do like to put into their master builder's risk. If you're working with a very large GC, they probably have one with their broker. That is one way in which they can control their risk across multiple claims, major issues, instead of having to go out and find a policy for every single project. So I would say most contractors, large contractors, have some kind of builder's risk program. Very similar, most contractors probably have some form of wrap for their liability, contractor controlled insurance program.
If builder's risk covers owner's property, would I still need to require riggers for movement of the owner's property by crane?
Yes. Yes. So riggers coverage has multiple components, which is it has the while on hook. So one of the things I just want to kind of point out is, understanding that in the rigger side, there can also be, damage caused by the rigging to your property. That's kind of a third party. So what I mean by that is, while most of the time you're not concerned about property damage that's being caused by fire, theft, vandalism, you're also not trying to cover every single thing that's being happened by a third party. You want to also be able to subrogate and go after somebody if their negligence caused it. So one of the things I mentioned is we had a contractor who was driving his automobile and drove it into a building. The building while under construction. The building had builder's risk. But also remember that that's a third party liability. It was a vendor actually who's dropping off equipment. Should also be held responsible, because why should you as the owner or the contractor have to pay the deductible when that third party was the one who did the liability? So understanding that there could be multiple coverages that balance out, and you can subrogate to reduce your financial costs, especially when it comes to deductibles or retentions.
Thank you, Anthony. I think that is about all the time we have for questions. Sherry, I'll turn it back over to you.
All right, thank you. I've been looking through the comments that were not questions, and there does seem to be some interest in having a 201-like session. I'll let you know we're going to have an open forum in July sometime. We haven't got the date communicated yet, but we will be sending out an email to that effect. I think that will be issue number 1 on the conversation, the discussion about that. We always do a regroup and a debrief over our webinars, but one of the things I think will be interesting is what to do and when to do and what the interest is in a 201 session. So I would encourage you to stay tuned for the email about our open forum in July. Other than that, we have 3 minutes left, and I have been told that as my job as moderator to make sure we don't go more than 2 minutes left. So in the interest of giving you about 3 minutes left in your life, I'm going to say we are pretty much done for the day, and I get brownie points for my extra minute. 2, in fact. Of course, I haven't stopped talking yet, so maybe just 1. Anyway, thank you all for coming. Really appreciate it. I know somebody asked about getting the slides. Paul, do you have a couple seconds so you can mention about, are we going to be posting slides or should we be emailing them? I don't know what the preference is for the group, but
yeah, so
them.
We'll be posting this this webinar on the website. That should go up next week. And if any members are interested in Anthony's deck, Anthony, we would welcome the opportunity to share it with the members if you're okay with that.
Yeah, that's fine.
Cool. All right. With that said, I think 10:58. Okay. Split the baby. All right. Thank you all for coming. Lovely to see you all, and we look forward to seeing you in July. Thanks a bunch. Bye-bye.
Thanks,
Thank
everybody.
you. Thanks.
Thank you.